Welcome everyone to BDO's webinar series that's designed for professional service firms. My name is Louis Keeping. I'm a tax director focused on advising professional service firms with over 18 years experience in the sector. I've put together the webinar series for the past 10 years. As a team, we work with a broad range of professional service firms, assisting on a number of matters from compliance and reserving matters to international expansions, structures, withholding tax issues, etc. For today's webinar, we're providing an update on the latest issues in India affecting the PS sector, and in particular focus for UK headquartered professional service firms. As I mentioned at the beginning, India continues to raise lots of compliance concerns and issues for our clients base, so highly topical. And today we're going to cover common structures for UK headquartered professional service firms operating in India, an update on tax considerations for professional service firms in India, covering things like 10Fs, PANs, etc. A regulatory update on foreign law firms considering opening an office in India and our latest commercial experience and what's happening there, as well as repatriation and exit strategies. So for those of you who don't already know, BDO is the world's 5th largest accounting network, providing auditing, advisory, and taxation services in over 165 countries. We've been long-standing advisors to the professional services sector, and our national professional services team is one of the largest dedicated sectors within a UK accountancy firm. Through our strong sector focus, we work with a full range of clients from boutique firms through to large international businesses, which include partnerships, privately owned corporates, listed, and private equity-backed businesses. So we've got 3 speakers today from BDO India. They are Bhavin Shah. Our professional services team work with Bhavin on a number of our clients, and he's a partner focused on direct taxes. We've got Gyanendra Tripathi. So Gyanendra is an indirect tax partner focusing on the sector. And finally, we've got Purvi Joshi, who's an associate director in the corporate counsel team, who'll provide an update on what's happening on the foreign law firms looking to open in India. So as always, we are running this webinar live and encourage you to ask questions using the Q&A feature, which is at the top of your screen. We'll pick up as many of the questions as we can at the end of the webinar, or if time does not permit after the session, we'll come back to you. We've had a number of questions raised in advance of the webinar when people have registered, and we've looked to cover as many of those in the presentation as we can. We will finish within the hour and share with you the slides and the link to the recording in coming days. So over to you, Bhavin.
Thanks, Louis. Thank you, everyone, for joining. Good morning, and many thanks to BDO UK team for having us, inviting here to share our experience and the knowledge as far as the professional service sector is concerned. Shall we move to the next slide? So as an entry strategy, now typically we have been receiving a lot of queries from overseas entities or businesses who want to set up their shop in India. So broadly speaking, it's there in the front of the slides to say that, what are the entry strategies you have. So one is, I'll just take one by one. One is the plain vanilla Indian company formation. So you form an Indian company with having at least 2 shareholders. Apart from the Indian company, there is another option, which is a hybrid of a company along with the partnership firm. So you form a limited liability company in India. The other is a foreign company continue to act without any formation of an Indian company or an LLP in India. It could be in the form of a branch office. It could be in the form of a project office or a liaison office. Now I'll come back to the foreign company at a later point in time. Now let's focus on the Indian company. Now there is 2 ways that you can form an Indian company. It could be a wholly owned subsidiary where the parent is owning 100% of the shares in the Indian company, or it could be a joint venture where you find out a 50% joint venture or a partner from India or from elsewhere. So that's how the Indian company can be formed in India. As far as LLP is concerned, again, you need 2 partners to form an LLP in India. Between the company and LLP, now there are certain areas of differences and there are certain areas where there is a common function or the common application being there. Depending upon the requirement and the objective, you can choose whether to go with the Indian company or an LLP as a structure. But having said so, if you look at from an overall perspective, LLP would be little bit less cumbersome from a compliance standpoint, whether it is requiring a company secretary, whether a requirement from an uh, annual general or a board meeting perspective, the LLP provisions are far more, are not so stricter as compared to the Indian company.
And Bhavin,
Moving,
just very quickly on that point, is there any restrictions on who can be partners of an Indian LLP? I.e., can they be UK resident or do they need to be Indian resident?
no, so partners could be both from outside India. That's not a requirement. Having said so, you need one designated partner, which has to be an Indian. And it's not necessary that you need to have an individual itself as a partner. Even a company could be a partner in an LLP.
Perfect, thank you.
Moving to foreign company, we have again three options. One is the branch office, the second is the project office, and third with the liaison office. As far as branch office is concerned, there are certain restrictions under the foreign exchange regulation of India is concerned. So there are conditions which is prescribed as to which foreign company or which foreign partnership firm can form a branch office in India. There, so long as you are satisfying those conditions, then it will be then you can form a branch office. As far as project office is concerned, you need to have a contract with the Indian customer for opening a project office in India. There are again restrictions in terms of who can form a project office and under what circumstances you can form a project office. And third is the liaison office. Now, typically a liaison office is more of a office which is going to collect the information and pass it on to the parent. So they are not going to indulge into any sort of a formal business or providing any services. So that's where the restriction arises. We'll see in the subsequent slides that branch office will most likely constitute a permanent establishment in India. So is the case with the project office. But when it comes to liaison office, it may not result into a permanent establishment so long as the business activities of the liaison office is confined to limited with respect to passing on the information and not indulging into any active business or providing any services. Now, apart from these six entities or form of presence that we have looked into, what we have also seen in past couple of years is foreign companies or foreign professional firms are indulging in setting up entity in GIFT City. So this is a particular international financial service center which is being embarked by the Indian government. And if you form a unit or if you form an entity in this particular sector, then you may be able to claim 100% tax exemption for the 10 years out of given first 15 years. So this is something which is coming up as a new trend, what we can say. This will be applicable provided the services have been rendered to outside India customers. So if you happen to render services to customers in India, perhaps this route may not be viable. Apart from GIFT City or the IFSC, you can also consider a referral arrangement or something like fly-in, fly-out operations, which of course Purvi will be able to take up in the subsequent slides, whereby the foreign company or the professional firms outside India did not have to set up any presence in India. Can we move to the next slide? Now, having said so, let's look at the tax consideration. We have seen all the structures. So broadly, I have just divided into three different baskets from the tax perspective. One is for the Indian company, second is for the LLP, and third is for the foreign company where you have a branch or a project office. Liaison office, as I said, so long as they not indulge into any active trade or active professional services, it will not be liable to tax in India. So as far as Indian companies are concerned, largely they would be liable to tax at 22% on their net profit. The effective tax rate after the surcharge and cess becomes 25%. The similar case in case of a LLP, the headline tax rate is 35% after including surcharge and cess. So you can see a marginal, there is a difference of almost 10% here. And as compared to a foreign company, which does not have any presence in India, the tax rate earlier was 40%. It has been brought down to 35%, but still the effective tax rate is 38%. So the highest tax rate is for the foreign company, which does not have any entity in India. As far as Indian company is concerned, whatever the profits they have in India, and if that has to be repatriated back to the overseas, there will be a distribution tax in the form of a dividend. So dividend is now liable to tax as per the tax withholding rate, which is applicable under the India vis-a-vis the tax treaty laws. So that's another additional tax that one would have to consider. Whereas in the case of a limited liability partnership, because tax has been paid at the partnership level, whatever profit that you share with the partners, that will not be brought to tax. So that's where the difference is. So if you look at if you compare 25 vis-a-vis 35, it looks on a higher side. But if you include dividend or the tax on the dividend aspects, which could be at least 10%, there is hardly or marginal difference, I would say, from the tax perspective. Of course, if you are looking from the other area, so for example, one Indian company is supposed to go for a merger with another Indian company. If you're looking for a business reorganization or something on those lines, the Indian tax laws clearly spells out that there is a possibility to claim or tax neutral merger is possible here. Whereas in the case of a LLP, there are no such specific guidelines provided under the Income Tax Act itself. So that's where, if you think that, you're going to come into India, look for opportunities, look for mergers, amalgamations, then I think it's better to go with the Indian company. I have listed down what are the due dates also. So for example, if it's a partnership firm and an LLP, where the audit requirement specifically from the tax perspective, it's not there, then it's 31st of July following the tax year. For corporates and LLP, where there is a tax audit requirement, but it's not having any transaction with the overseas group company, then it is 31st of October. And the last category, where there is a taxpayer, could be a corporate or could be an LLP, but there is a transfer pricing requirement of additional compliance has to be taken care, then the due date is 30th of November. Now, having said so, I think the very common question which arises for all the professional service providers from outside India in terms of handling with the customers is, what is the applicable withholding rate and what all documents do I need to provide?
That's the questions we get asked all the time, Bhavin. They're the most common questions we receive.
Absolutely, Louis. And this question has become far more important in this particular, in last 2-3 years, because earlier the domestic law provided a lower tax rate of 10%, including surcharge and cess, it was effectively 11%. If you compare it with treaty like India and UK, it provided 15%. I would have still gone to my domestic law, no major compliance I need to do. But now that 10% has increased to 20%. It has almost jumped the double. So the effective tax rate has become 22%, and hence most of the people will now be compelled to take a treaty benefit. So what I need to do as a non-resident or as a foreign professional service provider, when I provide service to my customer in India and I happen to collect the fees, what all documents do I have to provide to ensure that I am being governed by the treaty provision itself? So I think first is the tax residency certificate, which is absolutely a must that you need to provide, and that has to be made available for that particular tax year itself. What we have seen is many a times the tax residency certificate could be dated. It need not be for the year where you are providing the services. Similarly, in 2022, the tax authorities have come up with additional requirement to file Form 10F online. So you have to log into the income tax portal and ensure that you file the 10F online. 10F requirement is only applicable in cases where there are 6-7 prescribed particulars which are absent in TRC. Most of the time, what we have seen while dealing with the UK professional firms, that some of those 6-7 items is not available, and therefore it is mandatory to file Form 10F. The next is the no P declaration, which doesn't seems to be much of a worry. It's more of a declaration which has to be given by the professional service provider to the Indian customer. It also requires the professional service firms to file tax return in India. So this is very important. Many a times we have seen professional service firms, they take a position that look, the tax has already been withheld as per the treaty. There is nothing additional compliance that we need to do. Here is the catch. So the law says that so long as you are taking a benefit of a treaty, you must file tax return in India. Conversely, if your tax has been withheld as per the domestic law, which is 22% now, then you can be relaxed and say that, okay, I did not have to file tax return in India. This is again applicable to those service providers who are governed by the gross basis of taxation. So the moment you go into the net basis, so for example, if you establish a P in India, then the taxability will be on a net basis. So in that situation, whether you are governed by the domestic law or the treaty, you will still be required to file tax return in India. Moving further, I think very common thing, if you need a tax return to be filed, you will need a PAN, regardless, for whether you have opted for Form 10F electronically or not. So that's another area where you will have to have a PAN as well as a digital certificate in order to ensure that your tax return as well as for your 10F is being filed smoothly without any concern. Can we move to the next slide? Now, typically, any professional service firm which earns, let's say, fees for technical services or fees for professional services will be governed by the three different limbs of taxation which is there in front of you. So I'll just deal with the first limb, which is on fees for technical services. So typically, this will entail any sort of managerial or consultancy or technical services as far as the Indian domestic law is concerned. But when you come to the treaty, the word managerial is dropped. Also, there is an additional test which is being levied with respect to make available. So unless you don't satisfy the make available test, there is a possibility you can say that the entire service is not liable to tax. So what is this make available? In very simple terms, if your service provider is able to provide a service in such a fashion or in such a manner that going forward, the service recipient does not require the further services from the service provider, he or she is explaining how the service has to be conducted or how the report or how the deliverable has to be conducted in such a way that it is imparting a knowledge, it is sharing the experience with the service recipient. So if you are satisfying this test, or if you're not satisfying this test, then you need not have to worry and no need to withhold any tax as far as the fees for technical services are concerned. But come to independent personal service, which is the second limb. Now, these are professional services. These are specific services which involves around architect related services. It involves around medical services. It involves around lawyers. It involves around accountants. Now, these are more specific services and hence they would be governed by the specific clause, which is independent personal services. Again, here, the taxability would not arise so long as the service have been provided without having person coming into India. And if the person is coming into India, then the threshold is not breached. In India, UK treaty standpoint, it is less than 90 days. So long as you are providing services, let's say 89 days in a year, then it will not be liable to tax as far as the independent personal services, which are professional in nature. The last is equalization levy. Now, somewhere in 2020, the Indian government came up with the equalization levy at the rate of 2%. This is over and above 6% levy from an online advertisement standpoint. And this used to be a generic levy on any online services or any online sale of goods was concerned. This particular service has been, levy has been abolished from August of 2024, which means earlier anyone would have said that, okay, Instead of going under the treaty and getting liable to tax at 15%, let me go under the equalization levy and pay 2% tax itself. Now, because this has been abolished, the only remedy available is to look at FTS or IPS, or you go by the domestic law itself from an overall taxability perspective. Also, those who have claimed or those who have paid equalization levy as far as financial year from April 24 to August 24 is concerned, they will still be required to do their compliances. Can we move to the next slide? Now, here we are looking at, this is more a general. First, we have looked into FTS, which is more specific. We had looked into independent services, which was again more specific to the professional services. Now we are looking at the general services. So assuming you are not falling into all of the above two limbs, then you will be looked into whether you have a PE in India or not. So
And this is
PE,
probably, Bhavin, this is probably the most topical for our client base, because this is where we get the questions around how many days can my people spend in India? What does that look like for me? What do I need to monitor? So I think this is kind of highly relevant.
correct. So from a PE perspective, broadly, there are 4 types of PE. I will not want to focus on the fixed place PE and the other specific PE, and would like to focus more on the service PE and the agency PE. So service PE typically where a foreign company or a foreign service provider sends an employee or any other personnel into India for rendering any service to a client, and the person who's been deputed or been sent to India stays in India for a period of 90 or more days in a given calendar year, then that would constitute a service PE, which means the foreign company income which is attributable to the service PE would be brought to tax in India. If that person is rendering service to a customer which happens to be a related party of the service provider, then in that case there is a lower threshold provided in terms of number of days. So from 90 you come down to 30. So it is far more stringent that if you are sending a person for providing services to a group company in India, so you do not have to look at 90 days, you will have to look at straight away 30 days itself. Similar to service PE, we have a agency PE also. So any agent, and especially this is a dependent agent, who comes to India and he exercises in its ordinary course of business an authority to conclude contract, an authority to finalize the contract, or he even secures orders on behalf of the foreign principal. That's where the agency PE gets established, and hence the foreign company, whatever the income that is attributable from that contract which is received in India, now that would be taxable in India. Coming to typical issues that we have seen in terms of how to compute 90 days, 30 days threshold. So there is one common issue in terms of solar days versus man days. So let's say if there are 2 people who have come into India and they have serviced to an Indian customer, and their aggregate stay both came on the same day, both are departing on the same day. So aggregate period is 50 days. So should you consider 50 for 2 people, or should you consider 50 into 2, that's 100, and 100 crosses 90 days mark, and therefore there is a service P element getting triggered. So there have been ample number of judicial precedents and even the OECD commentary which suggests that you need to consider the solar days and need not have to not necessary to consider the man days itself. Now, this is a very, very big issue whenever we are looking from a factual perspective in terms of how to navigate or how to compute the total number of days. Another example is, should you consider casual working leaves? Should you consider weekends as a part of the overall threshold of 90 days? Answer is yes. So long as those are forming your casual leaves, so long as those are Saturdays and Sundays, on a conservative basis, you must consider them as a part of your 90-day threshold. But if you are going outside India for a specific leaves, those leaves should not be considered. If you are visiting independent agency PE, if you are visiting into India and you are simply negotiating with the customers in India. You are just, or rather, not even negotiating. You are simply just coming into India, explaining the Indian customer what are the pros and cons, what are the terms, all those things. Now, those period will not be considered. Now, here is the catch, because many a times people come into India from a business development perspective and they fear that this will constitute a service fee. The answer is no. These days need not be considered as a part of the service fee, so long as you are maintaining adequate documentation in terms of what have you done while you are in India. This is very, very critical. Many of our clients are not able to establish that while they were in India, what all activities they have undertaken. And that's where the litigation comes into the picture. The last thing is, even whether it's a service fee or an agency fee, now broadly, the Indian tax authorities have taken a position that so long as the permanent establishment is being remunerated at arm's length, then can you also look at for further attribution? Now, this is a very big question. There have been rulings in favor of the taxpayer to say that, okay, there is an agency fee, there is a service fee, but I have remunerated that service fee arm's length. There is a independent transfer study report which has been conducted. And based on that study report, there is nothing further to be attributed. So there have been rulings which have accepted this fact and said that there is nothing further. It is just an academical thing that we are doing a hair split. However, having said so, this matter is still pending before the higher forum, and it's just a matter of time that whether this litigation is going to put to rest on this. So what a professional service firm should do in terms of managing their PE exposure? I've just listed down few of the things that if you are from a duration perspective, ensure that your duration is less than 90 days. If you are coming into India, make sure that you don't enter into any sort of negotiation, any sort of securing orders, or anything to do with finalization of the contracts. Similarly, what you can do in terms of, you can have, even if you have a PE, you should undertake a separate benchmarking study basis which you are able to establish that the PE has been remunerated at arm's length. This could act as your second layer of defense to suggest that even if it's a PE, there is nothing further attributable, and it's more of an academic from a PE constitution perspective. Can we move next slide? Yeah. So so now we will be focusing more in terms of what is there in the budget, which has been recently announced, and it's going to come as a act very soon. And also whatever the new income tax bill, which has been announced 2 weeks back. So if you look at the right side of the two bars that is there, now, these are the two amendments which has been noteworthy from the Indian budget perspective. So the first is on the transfer pricing side of it. So instead of undertaking a benchmark on a yearly basis, what they have mentioned that the tax authorities, upon a revenue audit, will be doing a tax benchmarking once in 3 years. So they need not have to do a benchmarking every year. They are free to do a benchmarking once, and it will be made applicable for the next 3 years. This is subject to the taxpayer agreeing to this particular proposition. The second is safe harbor provisions. Now, we have the safe harbor provision, just that this time around, they are going to be far more additional safe harbors would be provided, and the percentage which is being provided on the safe harbor side of it could also be far more rationalized as compared to what we have right now. The another noteworthy change is with respect to the updated tax return. So this will be applicable in case of a taxpayer who misses an opportunity to file the tax return. So in that case, they were allowed to file the tax return up to 36 months from the end of the applicable tax year or the financial year. Now that 36 months, they have additionally extended, and they have said you can do a updated tax return not just for 36 but now for 60 months. It's almost like 5 years from the end of the financial year. Coming to the income tax bill, now the mandate was more to provide clarity, or more to provide a language which is far more simple to understand, ensure that there is no complications or no interpretational issues. So on that basis, they have carried out a mammoth exercise. It started somewhere in July, where finance minister announced that very soon we are going to have a new income tax bill. And then finally, in the month of February, mid-February, is where the bill was placed in the parliament. Of course, as a next step, the standing committee is going to give their comments on this particular bill, and then it will be put up in both the houses for the vote, and then, of course, the president accent will come into the picture. The key points here, no major change from the taxability or the scope perspective. Even the tax rate remains the same because these were never the mandates. What they have done, in fact, is they have reduced the content. So earlier, where we used to have an effectively almost 800 plus tax sections, it has been reduced to almost 500 odd tax sections. Earlier, we used to have almost 500,000 worth of words. It has been reduced by 50% to that. Most of the, instead of putting things in a very, very simple and formula driven, earlier it was more of a theoretical and it was more of too many words which is being used. So now they have replaced words with tables. They have made sure that all the scenarios are put across in a very lucid way. So that's a big update. There are few amendments. So for example, instead of the concept of previous year, tax year has gone, previous year and assessment year has gone. It is only now tax year. So you do not have to get surprised in terms of what is the assessment year, what is the previous year. So in a way, just an example how it has become very, very lucid now. There are few more changes, but I think those changes should be clerical in nature, which should be ironed out by the time the standing committee gives their final comment or go ahead on this. Can we move to the next slide? Gyan, would you want to take over? You're on mute.
Thank you, Bhavin. Thank you, Louis, and the BDO UK team, and to all the participants, welcome. So, from an indirect tax perspective, we have a goods and services tax, which is levied on all goods or services that are provided within the country. In case of non-residents who are providing services from outside India, the ordinary requirement is that the recipient in India would be liable to pay the GST on a reverse charge mechanism. There are few exceptions provided. The key exception here is in case of services which are provided online without having any physical presence, or which are being provided from outside India to any residents in India who are not registered for GST purpose. So a B2C transaction being done online with Indian residents by non-residents from outside India would require a liability to be fastened on the non-residents who are providing such services. Now, the online information database services, they are defined specifically as any services whose delivery is mandated by information technology over internet or over electronic network, where it is impossible to supply such services without the information technology. And then there is an inclusive definition which says that it includes advertisements on internet, it includes providing cloud services, provision of ebooks, movies, music, software, other intangibles through the telecommunication network or on internet, providing data or information retrievable or otherwise to any person in electronic form through computer networks, online supplies of digital contents, movies, television shows, music, and the like, any digital data storage, and any online gaming, excluding online money gaming. For this purpose, a non-taxable online recipient in India is defined as any person who is unregistered but receiving the OIDR services. It also includes any unregistered service recipients in India. It also includes local authority or government agencies or departments or establishments of the government. So, what are the implications in case of the OIDR services to service providers located outside India? A, whenever it is provided to any non-taxable online recipient in India, the non-resident is required to obtain a GST registration in India, which is a single GST registration with a single jurisdiction that is currently defined. Discharge the GST liability on all such B2C supplies. File your monthly GST returns reflecting the GST payment appropriately, and keep track of the status of your service recipients who are located in India for disclosure in the GST returns. In terms of professional services providers, what would qualify as OIDR? We are only talking about few examples. So one could be provision of e-books or any other intangible material through electronic network, providing access to a data or information repository through electronic network or internet, provision of access to any digital content on subscription basis, sometimes even online courses which are offered, or even assessments or examinations which could be conducted through the means of network. What are the points which are required to be mindful of for foreign professional entities? One, review your contracts and activities with your India customers and evaluate if the services are falling within the ambit of online information database access and retrieval, which is OIDR. Check the registration status of your service recipients in India. Preferably, you should also obtain the address details of the service recipients, because now it is also required that you have to report the liabilities basis the state in which it would be relevant, and track the status in which your service states in which your service recipient is located in case services are provided to non-taxable online recipients, which is under OIDR services. So with this, we can move to the next slide, please. Sorry, this is already covered. We can move to the next slide now. I'll quickly hand it over to Purvi to talk about the legal updates.
Hello, good morning, everyone. So I'm Purvi Joshi, as briefly introduced by Luis. I am an associate director with BDO India. I am a lawyer by profession with over 12 years of experience in litigation and arbitration areas. And I'll be discussing the regulations relating to foreign lawyers and law firms in India. So as you would be aware, sometime last year in March 2023, Bar Council of India had introduced the regulations governing foreign lawyers and foreign law firms and their practice in India. So these regulations had listed certain conditions for practice for lawyers and law firms, mainly being that practice is not allowed unless the foreign lawyer or law firm is registered with the Bar Council of India. The foreign lawyer or law firm ought to have a right to practice in their primary country of qualification, and practice is allowed only on a reciprocity basis, meaning the country of the primary jurisdiction ought to allow practice to Indian lawyers and law firms as well. So once registered, the registration will be valid for a period of 5 years, and which will require to be renewed 6 months prior to expiry. Registration fees being for individuals around 25,000 USD, and for firms being 50,000 USD. Renewal fees being 10,000 and 20,000 respectively for individuals and law firms. However, as per the regulations, in the event the foreign lawyer or law firm practices on a fly-in and fly-out basis, you are not required to register with the Bar Council of India. So fly-in and fly-out basis would entail basically that the law firm ought not to maintain an office in India for the purposes of practice. And secondly, that the practice of the lawyer or law firm in aggregate does not exceed 60 days in a period of 12 months. So while the term used in the regulations is practice to not exceed 60 days, Considering the lack of clarity and considering the fact that it would be difficult to bifurcate or substantiate the exact reason for having spent time in India for other than practice, one would assume that any time spent on business development or otherwise would also be included in these 60 days. Now, as far as the areas which are allowed for practice for foreign lawyers is concerned, the same has also been restricted to include only non-litigious matters, transactional work, joint ventures, mergers, acquisitions, advising on laws of the primary country of qualification, advising entities in foreign countries, providing legal expertise and advice on foreign laws in international arbitrations in India, advising on foreign law and international legal issues, excluding any Indian representation or documentation. The areas which are expressly excluded from practice are appearances before courts and tribunals and any involvement in property conveyancing, title investigation, or similar tasks. Could we move to the next slide, please? So now it's been a year since the introduction of the regulations. However, not many law firms have ventured into India. Till now, we have only one foreign law firm which has collaborated with with an Indian law firm. Other than that, not many are venturing in the market. Trend suggests that the foreign lawyers and law firms are more comfortable with the fly-in and fly-out mechanism. The reason appears to be the lack of clarity with respect to the tax treatment for the foreign lawyers. Indian lawyers too, as anticipated, especially mid and small size lawyers, are not very welcoming to the change, and they did file a plea before the Delhi High Court against the regulations for entry of foreign lawyers and law firms. And one of the reasons was the lack of authority of the Bar Council to have effected any such regulation in India. Recently, in February 2025, a bill has been proposed by the central government seeking to amend the Advocates Act, which is the governing act for practicing lawyers in India. So with the amendment, the bill basically is going to include foreign lawyers and law firms in the definition of practicing for legal practitioner, thereby recognizing them officially under the Act. Secondly, the bill is going to now grant powers to the central government to undertake any regulation or effect any laws pertaining to foreign lawyers and law firms. Given this shift in the power from the Bar Council to the central government, it is anticipated that there may be newer regulations and more encouragement to foreign lawyers and law firms to establish their practice in India, as well as an expected clarity in terms of the tax treatment for foreign lawyers and law firms. Thank you.
Thanks, Purvi. That's really interesting. I think it's watch this space and see what happens out of the proposed amendment.
Certainly.
So if you do a combined reading of what Purvi mentioned and what I suggested sometimes earlier, Louis, let's say there is a professional firm and they are sending their partner into India and they happen to stay 90 days. They happen to do a business development meetings in India. Now, as far as the PE risk is concerned, as I mentioned, if it is less than 90 days, you need not have to worry. Business development days are not counted. But if you look at what Purvi mentioned, the threshold is reduced to 60 days. In fact, even the business development days would also be get counted as far as your overall threshold of 60 days. So if you do a combined reading of these two together, then it is very, very restricted area that we are looking at.
Definitely.
So moving forward, I think one key aspects which we keep on getting questions in terms of, okay, I opened my business in India, I have done what am I supposed to do, but how am I supposed to get my money back to the home country? So which is a big question in terms of how to repatriate or how to get an exit from the India business. So if you can go to the next slide, we have listed down 4 options that one could consider in terms of getting the cash from India. So first is plain vanilla dividend. I think we have spoken earlier. This will be applicable only in a corporate structure, not in the LLP. Because in LLP, once you pay the tax of 35%, you can repatriate the profit back to the partner level, and there are no restrictions or there are no threshold which is prescribed. When it comes to corporate, as I said, there is a dividend as an option, but you will have to be mindful from the corporate law perspective, which provides some sort of a restrictions or thresholds It's not that you will be able to repatriate entire money outside India in one go. There are conditions which you will have to satisfy. Assuming you satisfy those conditions, there will be a tax withholding at India level. So if you are, let's say, if you're a UK shareholder and you want to be governed by the treaty, then the tax rate is 10%. But if you are going to govern by the domestic law, then the tax rate is 20%, excluding surcharge and cess. Including surcharge and cess, the effective tax rate is almost touching 22%. Of course, as I mentioned, the moment you go under the treaty, you will have to give TRC, no P declarations, Form 10F, and also do the compliances. Because you will be receiving dividend from the Indian subsidiary company, and that would constitute a related party, you will also be required to undertake a transfer pricing compliances, which entails local file as well as the TP certification, which has to be issued by a local Indian chartered accountant. The next is buyback of shares. So typically, again, this is applicable in case of a corporate only. The Indian company which is having so much of cash can look for buying back its own shares. Earlier, there was a different regime where the Indian company was being brought to tax at 20%. That tax was called as a buyback tax, but that has been abolished since a year back. So now the Indian company, whatever amount it pays as a form of a buyback, will have to treat this as a similar to dividend and will have to withhold tax. As far as the foreign shareholder is concerned, which is holding the shares, the cost of that shares could be treated as a loss, long-term capital loss or a short-term capital loss, depending upon the period of holding. And that loss, if you have any capital gains in that particular year, you are free to set it off. If you don't have the loss, if you don't have profits, then you can carry forward to the next year. Coming to distribution of profits, this perhaps is applicable in case of a LLP. Again, as I mentioned, once LLP pays tax, there is no further requirement. There is no threshold even from the corporate law or from the LLP Act perspective. You can straight away upstream the entire money out of India. The last is
just quickly on that one, on the LLP. If I'm a UK resident partner of the LLP, given the fact that tax is paid at the entity level, would I have an individual filing in India personally, if I'm a partner of an LLP, or as tax paid at entity level, I'm not required to file an income tax in India?
Yeah, so once the LLP pays tax at the headline rate, the share of profit which is received by the partners is totally exempt from tax in India.
Yeah.
So they need not have to do any compliances.
Fine.
The exemption is provided under the Indian Income Tax Act itself.
Perfect.
So that's an advantage of you having LLP vis-a-vis corporate structure. The last is the transfer of interest. So typically, in case if you want to sell the shares of an Indian company, or you want to assign the interest in an LLP to somebody else, now there will be a tax on that because this will be a direct sale of shares of an Indian company or interest in an LLP. There will be a tax liability, and depending upon the period of holding, the shareholder or the partner would be liable to tax in India. So these are the four unique, or I would say not unique, but these are the very widely and commonly used mechanism for upstreaming cash from India to outside India. There are other innovative areas and unconventional areas to repatriate cash from India. But again, those needs to be looked at into the overall objective and the factual exercise that one would need to carry out.
And as always, I think you need to bear in mind what your local country's taxation position is on repatriating such funds, i.e. respecting double tax, foreign tax credits, etc. So as we always know, dividend out can be more expensive than using an LLP example, but you obviously need to consider foreign tax credits and the double tax treaty.
That's correct. Also, you need to be mindful that in case if you're looking for any innovative ideas to repatriate cash from India, we already have general anti-avoidance regulations which will prohibit if the main purpose is to avoid a tax benefit. Similarly, I think India, UK also have signed MLI 1, which makes it difficult. I mean, in a way, you'll have to satisfy the principal purpose test, XYZ things. Only then you will be able to claim the treaty benefit. So I think that's it from my end. Louis, back to you.
Super, thank you. So I think kind of, as we mentioned at the beginning, we probably answered the majority of the questions in advance of today's webinar. So I think kind of we probably give you some bit of time back in your day today. So thank you very much for joining, and thank you very much to our BDO India colleagues for presenting today. As mentioned at the beginning, a lot of those questions, a lot of topics covered are questions we receive on a regular basis, and I'm sure on a lot of our clients and clients' minds. So hopefully that was useful. Any other questions, feel free to ask us separately after the session by email. We will circulate the slides and recording of this webinar in due course. So our next webinar is on 24th of April, and that's a GES and employment taxes update, which we can hope you can join us then. So wishing you all a lovely day ahead, and thank you very much.